Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theo Night Report for Thursday, August 25th. Now looking at the economic calendar for tomorrow, we have the second read on GDP for second quarter. Okay, big yawn, not much going on there. Consumer sentiment, not much going on there, but what we do have is Janet Yellen is speaking at Jackson Hole tomorrow morning at 10 o'clock. Now, the reason why this is important is beyond the title of her speech, which is Designing Resilient Monetary Policy Frameworks for the Future. Of course, everybody wants to know what she's going to be doing going forward in the future. So I guess what I'll do is create an alert for that to make sure that it reminds me that we have a fairly big event coming up tomorrow morning at 10 o'clock Eastern. Now, why is Jackson Hole such a big deal? Well, to answer that question, it's to go back to 2010. And you got to put yourself into the mindset of 2010, which is around this area here. Okay, so you have to go back to the summer of 2010, and this started off with what was called the flash crash. Back here, we dropped literally 100 S&P points in the space of one day. We recovered quite a bit of that, but it still kicked off a lot of volatility that we had. Remember, we had just recovered off of the 2009 bottom, and we've been rallying straight up for about a year, and all of a sudden, the trapdoor opens up, and everybody thinks, okay, here we go again. We're going straight back down to S&P 666 again. And so there was some merit to that. So at this point, at the end of August, Ben Bernanke stepped in front of the microphone and talked at Jackson Hole, and nobody had even heard of Jackson Hole before. And what happened was he talked about, yeah, you know what? I think what we're going to do is we're going to go ahead and print money in the form of investing into bonds in the market. And we don't care what happens to them after that. And you can see that the market absolutely took off, right? Absolutely just took off. So everybody plays the market in reverse, right? We all have memories and we don't have any kind of future vision as to what's going to happen tomorrow. So we end up sort of replaying all these events in our minds again and again and again, which is why everybody is still that traded through 2008, the bear market in 2008, keeps looking over their shoulder, wondering when the next bear market is going to show up. And the longer that they keep looking for it, probably the longer it's going to be until we do see something like that occur again. So since this Jackson Hole conference, everybody keeps looking at this Jackson Hole conference as another big FOMC meeting where they don't have a quiet period around it. Now, one of the reasons why obviously this was such a huge reaction is because of all the short interest that was accompanying this. I mean, we are peering over the edge of the cliff here, staring into the abyss, and all of a sudden, Bernanke, with one phrase, basically created massive amounts of short covering from that point. So can we look at today's price action with the same view and expect the same thing to occur from Janet Yellen looking forward into wondering what's going to happen with rate policy? I mean, looking at the CME group over here, count out to the FOMC looking for the 21st of September meeting, we still only have about a 24% chance at this point. Now, this could change tomorrow, so watch this carefully, but right now there's only a 24% chance that anything is going to occur in terms of a rate hike in about a month. As we get out to the 2nd of November, only a 28% chance, and then by the end of the year, 14th of December, this is where we start to see some real probabilities of perhaps some rate hikes, but a lot has to happen for that to occur. We have got to have more of these sort of blowout jobs numbers that are showing up. And I think the market is smart enough to look through the unemployment rate right now, which is somewhat artificially low because of the participation rate is so low right now as well. So the bottom line to me is that we've got this event tomorrow with Janet Yellen. What is she really going to say that's going to rock the boat that much? Are we really expecting another 2010 event to come along and to see another 100-point swing from the market coming along based on something that she says. I don't think so. I think the market might rise a little bit on certainty if she doesn't go outside the lines, kind of plays it down the middle of the fairway. But you never know. She really has not rocked the boat to this point. She really has not been very hawkish. She's been mostly leaning towards the dovish side of the equation lately, but a more hawkish stance, and we could come down here and revisit the 2100 level, which I think would be a tremendous opportunity at this point. So with that said, the other day what I did was I talked about just the incredible low realized volatility that we're staring at right now. So we can either just sit there on our hands and not trade anything, or we can sort of define a different way that we can trade. And what I've noticed over the past is when we do get very quiet price action, and you have to understand this is a massive change in character that we've had just since the June timeframe. So everything before this point was in a very sideways and volatile market. So sideways and volatile market requires a certain approach to be able to trade that. And usually big wide price swings that we have is usually accompanied by enough implied volatility that it's worth selling options during that. But since the Brexit low and we've driven above this 2120 level, the volatility has just completely been erased out of this market. So there's not enough to sell right now that's worth it, that's worth the risk. So what can we do instead to be able to take advantage of price action like this where we're just moving around just a little bit? Well, the one thing that we can do is we can go down in time frame. So here's the 1 hour chart on the spiders, and you can see the black lines that we have here is the after hours price action. Or should I say the gray lines is actually the after hours price action. But regardless, I mean, we still have a market that we can trade here. And it's about 6 times faster than the daily chart. So it's going to give us more opportunities to be able to look for extremes within this market. And the way that I would look for extremes in this market is, again, using something like the CHOP index, or we could use an oscillator. We could look for MACD divergences or crossovers, things like that. Whatever floats your boat, but what we want to look for is we want to see areas where we have extremes. So extremes in linearity of a move and be able to fade something like that to the downside. Again, more extremes up here. This is certainly even more extreme where we can fade that to the downside. And in this case, we can use very tight directional spreads. We can use our in-out spreads where one option's in the money, one option's out of the money. We can actually narrow those down to reduce the amount of risk that we're taking on these. Now the hold time for these, instead of about a month, is going to be dramatically shorter. We want to put the hold time of these probably at about 5 days or less. So it's going to be very important for us to set up a good till cancel limit order right off the bat on the entry of this trade, first of all, to be able to get our profit targets and not have to manage that automatically, right? The other thing that we'll have to do is to make sure that we are taking these trades off if they are not profitable, because if they're not profitable, they are subject to assignment. Even if we get the long option in the money slightly, it can still be assigned. So we don't want to deal with that. So we have to be more active with something like this. So again, that's the thought for today. When the market volatility comes out, what you have to do is go in time. And you can see that this market, so looking at this market on the daily chart, just so there's a bunch of candles going like that and not moving around at all. But if we zoom in to a chart with a smaller time frame, then there's certainly plenty of volatility to play with. We just have to use different rules and different execution and different management of the trade to be able to maintain our risk profile. That is it for today's report. Thanks for listening, and we'll see you on the weekend report. Take care.